For weeks, it felt like the entire market was just holding its breath. Bitcoin was trapped, completely struggling below this massive wall of resistance, and the entire financial world was watching. Then, in August of 2026, the dam finally broke. The price didn't just inch up, you guys. It absolutely exploded. But if you actually look under the surface, this wasn't your typical retail-driven crypto frenzy. Welcome to this MoneyForgeUSA explainer. Today, we're putting together the pieces of a major financial puzzle to investigate what really triggered this dramatic move. We're going to peel back the layers of Wall Street's hidden mechanics to show you exactly what is happening behind the scenes of this massive breakout.
$70,000. On August 19th and 20th, 2026, Bitcoin forcefully crossed this massive psychological barrier. Now, numbers like this really matter on Wall Street. When an asset spends weeks languishing below a major resistance zone and then suddenly just smashes right through it, it acts like a flare gun going off in the night sky. It immediately wakes up institutional algorithms, portfolio managers, and global traders. But look, the absolute worst thing you can do right now is blindly assume you know exactly why this happened.
Because that brings us to the core mystery we're trying to solve today. Is this just another retail-driven crypto pump fueled by online hype, or are the biggest, most powerful macroeconomic forces in global finance fundamentally shifting right underneath Bitcoin? Well, to answer that, we have to follow the money.
Okay, let's dive into this and peel back the very first layer: institutional money.
On August 19th, 2026, right as Bitcoin began its surge, U.S. spot Bitcoin ETFs suddenly attracted roughly $517 million in net inflows in a single day. Think about what that actually means in practice. A spot ETF has to actually hold the underlying asset, right? So a $500 million inflow directly drains available Bitcoin supply from the open market while aggressively driving up demand. It literally alters the entire supply and demand balance in real time. To put that into perspective, that single day of inflows basically swallowed up weeks of newly mined Bitcoin in a matter of hours. But you have to ask, why the sudden influx of Wall Street capital? And this brilliantly illustrates the difference in mindset between everyday traders and absolute financial titans. The retail narrative is purely momentum-based, Hey, Bitcoin is going up, so I should probably buy. But the institutional framework, it's entirely different. Wall Street is asking, where does this actually fit within a diversified portfolio? Institutions are using these newly approved ETFs for broad macro exposure, deep liquidity, and strict risk management. They aren't trying to time a quick pump and dump. They are fundamentally changing the market structure by weaving Bitcoin into traditional asset allocation. Which brings us to our next piece of the puzzle, Layer 2, the macro environment.
So right as Bitcoin was preparing to break out, the U.S. Treasury made an entirely unexpected move. They expanded long-term Treasury buybacks. Now, if you aren't familiar with this specific Wall Street mechanism, it's actually quite simple to grasp. A Treasury buyback is simply when the U.S. government steps in to purchase its own previously issued long-term bonds. Why would they do this? To inject massive amounts of liquidity and basically restore confidence in the bond market.
So the absolutely crucial point here is how this sets off a massive chain reaction across global finance. Let's walk through it. Step 1, the Treasury executes the buybacks. Step 2, bond market liquidity instantly improves, which really calms down institutional nerves. Step 3, because bond prices go up, Treasury yields, meaning the interest rates, move lower. And finally, Step 4, when yields drop, borrowing gets cheaper and capital naturally seeks out higher returns. This creates highly favorable financial conditions that essentially act like rocket fuel for risk assets. Bitcoin didn't just magically pump out of nowhere. The macroeconomic runway was being cleared for it.
Add to this the recent weakness we saw in the U.S. dollar index around the exact same time. Historically speaking, a weaker dollar really helps global liquidity and can support assets priced in dollars, things like gold, equities, and Bitcoin. But a quick word of caution here, it is absolutely not a guarantee. There have been plenty of macroeconomic environments in the past where the dollar falls and Bitcoin still drops due to other systemic risks. Think of a weak dollar as a tailwind, not a promise.
Let's move on to the next major factor and see how this builds into explosive market action with Layer 3 market mechanics.
To really understand the sheer violence of the $70,000 breakout, you have to understand a concept called a short liquidation. When a trader shorts an asset, they are essentially betting borrowed money that the price is going to go down. If they're wrong and the price actually goes up, they start losing money fast. A short liquidation happens when their losses get so incredibly bad that the exchange literally steps in and forces them to buy the asset back at the higher market price just to cover their debt. Let's look at how this creates a completely chaotic feedback loop in the real world. Imagine a trader shorts Bitcoin at $66,000. Suddenly, that institutional ETF demand and those Treasury mechanics we just talked about cause the price to spike. The trader's margin fails. The exchange forcibly makes them execute a Bitcoin buyback. Now multiply that forced buyback by thousands of overleveraged traders globally. Price rises, shorts liquidate, forced buying occurs, which makes the price rise even further, liquidating even more shorts. It's wild.
And that brings us to this staggering number, $2.7 billion. During this broader crypto rally, recent data shows roughly $2.7 billion in short positions were totally wiped out and liquidated. Just let the sheer scale of that number sink in for a second. This forces us to ask a very uncomfortable but completely necessary investigative question. How much of this massive push above $70,000 was driven by genuine, long-term Wall Street demand, and how much of it was just desperate, forced buying from liquidated traders? So, it's time to synthesize these forces for a moment with the reality check.
So is this rally real and sustainable? Well, we're really looking at three distinct scenarios here. First, genuine institutional accumulation, where spot demand holds strong and ETF inflows just continue to absorb available supply. Second, a temporary short squeeze, meaning once the forced buying of those liquidated traders disappears, the momentum completely falls apart. Or third, a macro liquidity rally, where Bitcoin is simply rising with the tide of generally improving financial conditions and lower yields. The reality of the situation is all three of these scenarios can happen, and honestly, likely are happening simultaneously.
So instead of jumping on social media and looking for these wildly exaggerated $100,000 price predictions, we need to look at what professional investors are actually monitoring to gauge the health of this market. They are closely watching ETF inflows versus outflows to see if the demand is sticky. They're watching U.S. Treasury yields and the dollar index to monitor overall global liquidity. They're tracking open interest to see if dangerous leverage is building right back up again. And most importantly, they are watching Bitcoin's ability to actually hold and consolidate above that crucial $70,000 breakout zone.
What is really fascinating here is how perfectly balanced the macroeconomic arguments are right now. On the bull side, continued ETF demand, a weaker dollar, and improving liquidity form a seriously powerful foundation. But remember, the market absolutely doesn't owe you anything. Look at the bear case. If Treasury yields suddenly spike, if inflation concerns return, forcing the government to tighten conditions, or if we see sudden, massive ETF outflows, the bear case takes over entirely. Bitcoin is, and absolutely remains, a highly volatile asset that is heavily influenced by traditional macroeconomic shocks.
Now, let's bring this all home to you, the everyday American investor. Look, we are not here to give you financial advice, but we are absolutely here to talk about responsible, long-term portfolio strategy principles. A mature investor does not blindly chase a $70,000 breakout. You must honestly assess your personal risk tolerance. You prioritize smart position sizing and vast diversification. You always maintain an emergency cash fund entirely outside of volatile markets. You strictly avoid the kind of leverage that caused those $2.7 billion in liquidations we talked about earlier. And rule number 1, never, ever invest money into a volatile asset that you cannot afford to lose. As we wrap up this investigation into the August 2026 breakout, I want to leave you with a thought that perfectly summarizes everything we've uncovered today. The real question isn't whether Bitcoin can go to $100,000. The real question is whether the money flowing into Bitcoin today is strong enough to keep buying after the short sellers are gone. And that is exactly what Wall Street is waiting to find out. Is this the dawn of a massive, macro-driven institutional era for digital assets, or just a momentary illusion created by squeezed traders and a helpful U.S. Treasury?
A quick reminder before we go, this explainer is strictly for educational purposes and is not financial advice. Always do your own research. But I really want to hear your analysis on this dynamic situation. Do you guys think Bitcoin's $70,000 breakout is the beginning of a sustained new rally, or just a temporary short squeeze? Let me know your thoughts down in the comments below. Thank you so much for watching, and I'll see you in the next explainer.